TFSA, RRSP, FHSA. Which account should I use? And why do I need it? What's going on, guys? Welcome back to my channel. I'm Manny. Today we're going to cover some quick facts about some Canadian accounts that you should be aware of. When it comes to investing, a tax-free savings account, a registered retirement savings plan, and a first home savings account are all great accounts. They all have tax advantages, and they also have flexibility with a variety of investments such as GICs, mutual funds, and many more. Now, the question is, how do you know which account is the best fit for you? And that is what we're going to talk about today. So let's dive deep and take a closer look. All right, first, let's take a look at a tax-free savings account, also known as a TFSA. So this is a Canadian registered account where investment earnings and withdrawals are tax-free. Canadian residents who are 18 years or older are eligible to open this account. Annual contributions to a tax-free savings account for 2024 is $7,000. plus any unused contribution from the previous year. In other words, if you open this account today, or you already have an account, you can contribute to this account. However, there's a limit of $7,000 that you can make per year. In addition, if you haven't contributed to this account in your previous years, you can carry over any unused contributions from your previous years. If you're making contributions to this account, right, the only way to know if your account is actually growing or losing value is by knowing the interest rate on the account. The only way you're going to get some type of growth on your TFSA is by earning at least minimum 4% interest rate, which will give you a growth about 1% due to inflation being around 2 to 3% every year. Well, Manny, if my account is growing by just 1%, what is the whole point of having a TFSA? Well, this is where I come in as an educator and a licensed professional to help you assess your risk tolerance that will dictate what type of growth will be suitable for you. You can earn more than 4%, you can earn 6%, you can earn 10%, you can earn 15% interest rate on your tax-free savings account. It all depends on your risk tolerance. Let me ask you this. If you knew you could get better growth on your account, if you knew you could get better growth in what you put in, if you knew you could get better growth on your investments, wouldn't you want to explore alternative options? Wouldn't you want to know what else is available to you? I mean, anybody would if you ask me. The thing is, you don't know what you don't know. And this is why I'm here to guide you and help you get to your financial goal. Okay, I hear you, Manny. Okay, I hear you. Okay, so explain to me again, why do I need a TFSA? That's a very good question. I'm glad you asked. Any income, dividends, capital gains that is earned in a tax-free savings account is 100% yours. You will not be taxed on what you earn, and there's no penalties for making withdrawals. You can pretty much take out the money whenever you want and whenever you need it. It's a great liquid investment tool and the easiest way to build an emergency fund. All right, now let us discuss RRSP, which is a registered retirement savings plan. So this is an account where contributions are tax deductible and investment earnings in the account are tax deferred. You guys understand when I say contributions, right? It basically means you have this account and you're putting money into it, right? Tax deferred basically means you will not get taxed now. Any investment earnings in that account or any contributions that you're putting into the account will not get taxed now, but it will be taxed at a later date or when you take it out. Canadian residents between age 18 and 71 who have earned income and who have filed tax return in Canada are eligible for this type of account. The annual contribution of an RRSP is 18% of last year's income minus any pension adjustments up to a maximum amount of $31,560 for the year 2024. So when it comes to the tax benefits of an RRSP account, contributions towards this account are tax deductible up to your personal deduction limit. So when I say tax deductible, what that basically means is that whatever amount that you put in your RRSP for that year, you will not be taxed on that. It's considered to be known as tax deferred until you decide to withdraw, until the year you decide to withdraw from that account, at which point it will be known as taxable income. All right, let me give you guys an example because I really want to help you guys understand this strategic concept, right? Let's say last year you made about 40 grand. Your annual income for last year was about 40,000, right? So the maximum contribution that you can make towards your RRSP is 18% of 40 grand. All right. So what is 18% of 40,000? All right. Let's do this calculation quickly. Right. So that brings you about 7,200. So 7,200 is considered tax deferred. Right. So now instead of your annual income being taxed at 40,000, your annual income now is being taxed at 32,800. Right, which brings you at a lower tax bracket. All right, guys, so I'm not a tax expert. What I'm giving you is just illustrations and examples for you to understand the general idea. Right, I would strongly recommend for you to talk to your accountant so that you can get more details, because every situation is different. This is a case-by-case situation. I'm just giving you guys an example of the general understanding so you can understand this strategic concept. So the example that I just gave you is one of the very reasons that you would want to consider having an RRSP account. The reason being is because you pay less income tax. Each year, the amount of money that you contribute towards your RRSP up to your allowable limit can be deducted from your taxable income for that year. So now a great financial strategy to actually consider is to enroll in an RRSP account at your workplace, especially if they match your contributions. So now, in addition to that, let's say you have a registered business, right? Whether it's sole proprietorship, partnership, corporation. Did you know that you can claim business expenses to deduct your tax as well, in addition to your annual income for that year? Now, I don't know about you guys, but doesn't that sound like a way better strategy than working 2 to 3 jobs? I'm sure most of you can relate to this, because this is a real life crisis that most of us are facing in today's age. Now, the decision will always be yours. I'm just here to give you the information. All right, let me give you one last example and we will wrap this section up. Right, let's go back to the 40 grand example. Right, last year, your first job, right, you made 40 grand. Okay, this is just for one job. This time, you did not contribute to your RRSP. You don't have an account. You don't have an RRSP account. You didn't open one. Your second job, right, you made about 30 grand, right? And with that job, you didn't open an RRSP. You don't have any contributions, right? So now that brings you up to $70,000 of annual income, which basically means that your annual income, your annual taxable income is now sitting at $70,000. Now, once again, I'm not a tax expert. I would strongly recommend for you to speak with your accountant so that they can get to the specifics of your marginal tax rate, because this examples that I'm giving you guys is just a general information, general examples for you guys to really understand the concepts of what's really going on. All right, now let's talk about FHSA, First Home Savings Account. So this is a registered account for first-time home buyers where contributions are tax deductible, the investments and the withdrawals are tax-free. Now, the eligibility to have and own this type of account is available to Canadians between ages 18 to 71 who are considered to be first-time home buyers. The annual contribution for this type of account is $8,000, right? Plus an additional limit amount of $8,000 of unused contribution room, up to a maximum lifetime limit of $40,000. In regards to the tax benefits of an FHSA account, contributions towards this account is tax deductible up to the annual and lifetime limit. In addition, the savings in the account grow tax-free if you use the funds to qualify for your first home. If you've made it this far and you are enjoying the valuable tips and info, I would really appreciate it if you give it a thumbs up, subscribe to the channel. I really appreciate your love and support. Guys, let's help one another become financially literate so we can make better decisions for the future. Now, one of the most frequently asked questions about an FHSA account is, can you open this account if you already own a home? Okay, so the whole purpose of having this type of account is to encourage and help Canadian residents purchase their first home, right? Because as you know, the way the cost of living is in today's economy, the government has made it a little bit easier and flexible for people to live comfortably. With that being said, having this account is very, very beneficial for people who are purchasing their home for the first time. So to answer that question, let's say you own a rental property, right? And you haven't lived in that home in that current year or for the previous 4 years, you are eligible to open and have this type of account. All right, so the second FAQ is, can you open an FHSA account if your spouse already owns a home? All right, so to answer that question, once again, the FHSA account is to encourage and help people, Canadian residents to be more specific, buy their very first home, right? If you are married, if you have a spouse and your spouse already has own a home, right, then you won't be considered eligible, right, because both of you needs to be first time home buyers. All right, let's get to the last FAQ about a first home savings account. And the question is, can you open an FHSA account if you own a rental property? Yes, you may, under certain terms and conditions. And the condition is, if you haven't lived in that property for the current year or in any of the 4 preceding years, you are more than welcome and eligible to have an FHSA account. Yeah, that's all for the quick facts that I have today, guys. If you have any questions, please feel free to drop it in the comment section below. Also, please feel free to send me a private DM. I'd love to answer all of your questions and to help you get to your financial goals. Until then, I'll see you guys in the next video.